Everybody, we're going to be talking about BPRs, also known as balanced price ranges. And what these are is an area that acts as support and resistance. Generally, what we see is they hold pretty neatly compared to a fair value gap that will sometimes wick through, and we can even invalidate it below the swing point or below here. BPR, we want to see price really respect that. It can wick below. We want to see respect the bodies, just like like an FEG, but we don't really have an invalidation point. So as soon, like that's structural. So as soon as price comes below here, the BPR is essentially invalidated. Now, just like an FEG, we want to see a BPR come from an area of liquidity. So into an area of liquidity, and it's made up of two fair value gaps. So you get one fair value gap or one imbalance down into liquidity. And then after the liquidity grab, we get a new imbalance overlapping the previous imbalance away from the liquidity grab. So in a bullish scenario, you would have a bearish candle and then a gap up. And in a bearish scenario, you would have a bullish candle and then a gap down through it. So how we mark this out is we get the smaller candle, then we extend it over. So you get the smaller candle, extend it over, and then we want to refine it so that there's no wick included. And then just like this, you get your balanced price range, right? So as price approaches back to it, we want to view this area as our support and resistance. All right, we'll look at another example on the lower time frame. So here on the daily, we have our swing structure and our ISPs, just for context. And now on the 4 hour here, we can see that same BPR very clearly. You can see that they're still visible on the 4 hour as well. But what we want to do is we want to just get clarity and mark these out on the higher time frames. As price pushes down into it, you see it holds as support very neatly. Then price pushes away, and again we see liquidity build up before this FEG, where we liquidate liquidity, we liquidate stops into this FEG and then push away aggressively. And I want you to look here and notice we have this aggressive push in that has a gap, and then an immediate aggressive push out from that creates another gap. So an FEG would be this whole area here. And you can see, though, when we refine it to that smaller candle to the BPR, this large area is refined to a much smaller one. So we have a much smaller area of entry. And if we were entering on the FEG, what we would have is something like this. Enter on candle 2 and stop below candle 2, and we'd have a fairly big stop. Whereas here, with the BPR, our stop is much more refined, and we can have our entry just on the BPR, and then you can even put the stop just somewhere below it or treat it like an FEG and cover that candle too. And you can see that RR went up double just because of our use of the BPR. Another example is right here, where we have a push down gap into a liquidation, a push up aggressively, gives us a gap here, like so. So instead of, if we wanted to enter, instead of entering like this, covering this low, we can see that we have a much tighter area of entry, and we can even look at something like this, just giving that BPR a little bit of room to breathe, right? And yeah, that's it. It's a balanced price range. Pair it up with your structure, pair it up with your bias. Of course, make sure that it's in your direction, but oftentimes this can bring some clarity, especially when you have multiple FEGs. You can favor the BPR over one of the other FEGs, so you can just include that one FEG that's in the construction of the BPR. Thanks, guys.